Hello and welcome to Kitco Mining's Digging Deep, sponsored by Revival Gold, in which we take a deeper look at some of the week's mining and exploration news. Joining me today is Nicole Adshead-Bell, Principal of Cooper Advisory. Nicole, welcome back to Kitco.
Thank you very much for having me, Paul.
We have a lot to talk about this week, Nicole, but first, please note that Digging Deep is not investment advice and the opinions expressed here are our own and not Kitco's. And of course, don't forget to hit that subscribe button. M&A. First Majestic Silver today announced it is to acquire fellow Mexican silver producer Gatos Silver in a $970 million all-stock deal with a 16% premium as the company returns to its roots in Mexico for growth. Gatos owns a 70% interest in the Los Gatos joint venture that owns the producing Cerro Los Gatos underground silver mine in Chihuahua. Adding that mine to its San Dimas and Santa Elena mines will consolidate First Majestic with aggregate annual production of 30 to 32 million ounces a year of silver equivalent through the addition of 9 million ounces from Gatos. First Majestic's previous transformative transaction was the $470 million purchase of the Jarrett Canyon gold property in Nevada in 2021. That did not work out so well, with the company struggling to sustain production there and suspending operations in March of last year. But Gatos has also had issues. Following its 2020 initial public offering, the company was a darling silver stock until in January 2022, it announced that its technical report had errors in it, which forced the company to rebuild its reserve and resource estimates with the reductions of about 30% of its metals. First Majestic got itself into position where it had to do something new. And now, as I said, it's going back to its roots. That seems to be a sensible thing, Nicole. Is First Majestic buying production like this a surprise?
No, actually, it isn't. I think that this deal makes a huge amount of sense, geographically speaking, strategically speaking, versus their Jarrett Canyon acquisition. I think that the leadership of First Majestic, they understand the value of paper, and it's a company that is very, very well valued. And if you have highly valued paper, the most accretive thing that you can do with that paper is acquire another company, i.e. issue paper for assets in that company, or you can issue paper for shares. And I think that First Majestic has a history of understanding relative value and acting on it.
Okay, well, after this transaction, I think Gatos Silver shareholders will own about 35% of First Majestic. Now, there aren't that many primary silver projects, mines, or companies out there. Are you surprised that First Majestic perhaps didn't go for somebody like Silvercrest or a developer like Vizsla Silver?
Number one, for a deal to be done, there has to be a meeting of minds at the management and board level. And those social issues are commonly the elements that preclude transactions. I think Silvercrest is unlikely for a whole multitude of reasons. So I think that this deal actually does make sense. Number one, it's a deal that could be done. Number two, single asset developers and producers. This, as we've seen with recent events with Victoria and other companies, is very, very high risk. And we live in a world, because of the ETFs and trading around those and demand for companies where size actually matters. So I think that this transaction was doable. It creates a larger silver producer. There's very, very few, as you said, primary silver deposits out there, and that's a function of the geology that's related to silver mineralization.
Now, for a relatively modest-sized company, Gatos Silver has quite a high market capitalization of, give or take $1 billion. First Majestic said that pro forma, the resulting company will have a market capitalization of just shy of $3 billion. So having the size and scale there that you mentioned is clearly part of this deal. And also, in terms of the socialization, if you like, of the deal, this one's perhaps a little bit easier as well, because Gatos Silver has a key shareholder, the Electrum Group, which has about 32% shareholding. So, and they've come out and said they support the deal. So presumably that makes everything simpler to close early next year.
Absolutely. And for those that don't know, if you're a TSX listed company and you're issuing more than 25% of your shares to acquire an asset, or in the event of an equity financing, that requires a shareholder vote. So both Gatos and First Majestic in this situation require shareholder votes.
Okay, sticking with silver, Blackrock Silver reported a preliminary economic assessment for the Tonopah West Project in Nevada to produce 8.6 million ounces of silver equivalent for 7.8 years at an all-in sustaining cost of just shy of $12 per ounce, following an initial capital investment of $178 million. an IRR after tax of 39% there. Nicole, it looks like the Silver State could have another silver mine. It's perhaps more famous now for gold, but it is called the Silver State. Although Nevada is a mining state, this project is pretty close to Tonopah. Will this be a challenge for Blackrock or somebody else to advance the project?
I think permitting anywhere in the world is a challenge. It's particularly a challenge in the US, and it really does vary state by state. And once you have your permit, the way that the system works in the States is that then you can be litigated essentially in perpetuity in terms of precluding development of that project. And so once your asset is up and running, I think the US is one of the best places in the world to be. But yes, there will always be inherent risk around permitting a project. And it's the not in my backyard aspect that takes. The closest you are to an existing mass of people, so a town or a village, then that increases that risk.
Okay, that being the case, permits can be obtained in the US, as Perpetua Resources expects to receive very, very soon. The company said today that US Forest Service completed the final environmental impact statement and is issuing a draft record of decision, which will authorize it to build the Stibnite gold project in Idaho. The final record of decision there is expected by year end. Stibnite has 4.8 million ounces of gold reserves and is expected to produce over 450,000 ounces per year during its first 4 years of operation, as well as an antimony byproduct. The reach and extent of Perpetua's environmental program and fish habitat restoration seems to be a very critical aspect here. Nicole, the US Forest Service is often viewed as one of the most challenging federal agencies to permit with. So how important is this decision, do you think?
I think it's an incredibly important decision, but let's just take a step back. Perpetua, formerly Midas, and a very, very good friend of mine used to run it and really did, Stephen Quinn did a lot of the heavy lifting in terms of, I think, creating the foundation for its permitting pathway. But this is a process that has taken in excess of 10 years. So just think about that, back to the complexity around permitting in the States. And there's a whole number of issues for that. But again, permitting timelines can be very, very extensive in nature and also very, very uncertain. And once they do, if they do receive the record of decision, that is an automatic step to start advancing aggressively the project, because then litigation can start to occur. And that litigation will be very, very well funded because there's a relatively large anti-mining contingent in Idaho.
I visited the project a couple of years ago, and the fish habitat restoration, the company is really looking to go above and beyond what's perhaps required by the regulations and what's required for the compensation of the impacts. So this, I think, is a very positive development for the company. What they're doing there is, looking to do there is first rate.
Absolutely, and that was the approach taken by the previous management team and continued with the new management team, not so new anymore, management team and board, which was to go above and beyond, acknowledging that this was going to be a project that would have a lot of eyes and trying to educate and bring the local population along with you as you're trying to advance this through the permitting process.
Now, while we're on the subject of first-rate developments, I am currently on an analyst site visit to Calibre Mining's Valentine development in Newfoundland and Labrador. The mine build looks to be going well, about 80% complete. The team is very positive and motivated. The company is putting capital into things that the previous owner, a single-asset junior developer, did not have the resources to do, as it was capital constrained, such as exploration and optimizations. Everything looks really to be going well. The company expects to produce first gold sometime in the first half of next year. Nicole, Calibre seems to have navigated the ownership transition of this asset relatively smoothly, which isn't always the case with M&A. Let me ask you a broad question here. Why does M&A often go wrong?
It often goes wrong, I think, for a number of key reasons. One is, despite what people think, often M&A is driven by one or two big personalities within a company. And they like an asset, they have an intent to acquire that asset, and then don't necessarily listen to the technical people. Number two, corporate development teams are almost always led by people who are not technical. So ex-bankers, ex-finance types, and again, when the technical people, and if you're an ex-banker, you're used to trying to get deals done, and they're your main driver, and often your KPIs and your compensation is linked to that. And then you have the technical people that come in and look at an asset, and they're always the negative Nellies. You speak to anybody who works with corporate development that's technical at any mining company, they'll complain about the fact that they don't get listened to. So I think that often due diligence falls down on technical merits. And then the biggest risk in the due diligence portfolio is around geological risk. So you can work on community relations, you can work on engineering, you can work on your metallurgy, but you cannot change the rocks. So if the resource estimate is wrong or aggressive, and that is where your biggest risk occurs in any asset, development or producing, then that will result in a material negative consequences. And so just back to Calibre, you say Calibre, I say Calibre. I just actually updated myself on their latest presentation, and I'm sure this is a question that you have asked when you're on the site visit, is some of the perceived issues around that asset were around resource risk. And the question that I'd be asking, and the way that I'd want to de-risk that risk as an acquirer of that asset, is through doing a detailed grade control drilling program to reconcile that against your resource or your reserve in this case. And so to ensure that what you think is there is actually there, so that you're not getting in negative surprises as you go through the mill. And then just lastly, I want to touch on one thing. When a company does material M&A or acquires another company, board has to approve that. And what we have seen, I would say, both a regulatory and an ideological trend with respect to board members, etc., that's really focused on physical diversity or self-identification diversity versus relevant industry experience. And it shocks me as I go and look on boards of some of the largest companies in our sector, how very few people on those boards have any mining industry experience. So no geos on the board, no mining engineers on the board, maybe a few directors that have some banking experience. So if you don't have expertise on your senior leadership to be asking the questions about risk, and obviously any transaction has risk, and then to be able to understand the answers to those questions, I would say there's another layer of risk that has perhaps increased over recent years in terms of technical expertise.
Well, some of those things have certainly come out during this week's visit. The technical team at Calibre is very, very strong. President and CEO of the company, Darren Hall, has built 4 or 5 mines. The most recent one prior to this was Boddington in Australia. A lot of the development team have got backgrounds with companies like Barrick Gold and Vale, so very high caliber of personnel there. And to your point about the resource, the company recently put out, I think maybe this week or last week, a press release doing just that. They did some drilling right slap bang in the center of the deposit to do that reconciliation, and they found there's more ounces, even a bit of higher grade as well than was in the model. So all looking good here in Calibre. Now, this bringing Valentine into production will boost Calibre's aggregate output from around, say, 200,000 ounces a year towards 500,000 ounces per year, making it one of the larger intermediate producers. Nicole, how important is it for a producer to obtain this level of production scale in order to thrive and attract new investors?
Again, size is very, very important. If you want to attract generalist investors, for them, essentially a junior company is $1 billion company in the generalist world. And so in mining, if you want to attract the marginal investor, which creates torque and pressure, upwards pressure on your share price, size really, really does matter. And so if you can be one of those few companies that grows through accretive, well-executed M&A, I think you'll be materially rewarded in your share price. And what we see in our industry, both with big companies and smaller companies, is there's an unwillingness to acquire development companies because of the risk around that. And so those companies that do, and obviously Calibre was one of them, and that can execute, I would also, just as a segue, there's very few groups that seem to have the capabilities, and we could spend a whole hour talking about this as to why this is, but they seem to lack the capabilities around execution. And so those few companies that can do it and do it well, I think they're actually in a very good sweet spot, because despite this incredible run that we've seen in the gold price, we have not seen those valuations reflected in the junior sector. And that's because there's a perceived lack of appetite from an M&A perspective in terms of being exposed to the developers of the gold side of things.
Now, one of the benefits, one of the things I enjoy on going on site visits like this is spending time with other mining analysts, and gossiping, hearing what they like and what they don't like in the space. I imagine you know exactly what I mean here. This time around, there was quite a debunk over dinner about all-in sustaining costs and how companies juice their numbers by what they include or do not include in their figures, and who some of the worst culprits are. All-in sustaining cost is a measure conceived in 2013 by the World Gold Council to provide a yardstick to measure all companies with. Mining analysts say the way many companies ignore the guidelines inevitably means that all-in sustaining cost is a number that does not mean anything. Nicole, why do you think all-in sustaining cost hasn't achieved what the World Gold Council set out for it to do?
I think you have to look to companies' incentives. And obviously, if part of your incentive package is to ensure that you're in a certain segment in terms of your cost profile, it behooves one to ensure that those metrics work in your favor. And if there's a lack of hard and fast rules around that, it can cause the discrepancy that we see. So those companies that are conservative and doing a good job, that are reflecting their real cost of producing an ounce of gold, perhaps look less positive from a financial perspective. Now, I think that there is one way that you can address this. It takes a little bit of effort, and the investing industry tends to be somewhat lazy, if I'm going to generalize. But if you want to truly understand the profitability of an ounce of a producing company, the way that I look at it is to go to the cash flow statement. Because the problem with earnings is there's all this kinds of accounting wizardry. And so none of us will be able to distill that in a meaningful way. But if you go and look at what is really cash in out of the company, and that's the best indicator, I think, of financial health. And so if you look at operating cash flow, and then you take a look at your investing cash flow, so you have to exclude one-off events, but investing cash flow captures that capital that needs to be put into the company at the asset level that you may have taken out of the operations level. And so to better understand the true cost, it's to look at those two key metrics, I think.
Excellent. Well, you just answered my next question for you, which was, if AISC is effectively meaningless, what can investors do to compare companies on a like-for-like basis? But you've already answered that. We're going to take a quick break now. We have a lot more to come. But first, a word from our sponsor.
Revival Gold, ticker RVG on the TSXV and RVLGF on the OTCQX market, is one of the largest pure gold mine developers in the United States. The company is advancing engineering and economic studies on the Merkur Gold Project in Utah and mine permitting preparations and ongoing exploration at the Bear Track Arnett Gold Project located in Idaho. The company is financed and currently focused on the completion of a preliminary economic study on heap leach gold resources at Merkur and continued exploration along 5 kilometers of underexplored structure at the company's multi-million-ounce orogenic gold system at Bear Track Arnett. For more information, please visit www.revival-gold.com.
Welcome back. Nicole, you were talking before the break about companies that can deliver. One company that is delivering is G Mining, who said this week that its Tocantinzinho gold mine in Brazil has reached commercial production, which it defined as 30 consecutive days of the mill operating at a minimum of 60% of nameplate capacity. During August, it operated at 76% of nameplate capacity, processing 9,800 tons per day with a recovery rate of 88%. Tocantinzinho will have a 10.5-year mine life with production of about 175,000 ounces per year. Nicole, G Mining seems to have done a great job there, and the company is rapidly becoming one of the most exciting and fastest growing gold producers. What's the secret of their success?
They can build a mine. Simple as that. The thing that they do benefit from with Tocantinzinho, and I'm pretty familiar with that asset, it's a WYSIWYG asset. What you see is what you get. It's very, very simple metallurgy. It's a single open pit. It's kind of hard to screw that one up. But this is a group of people that have a reputation in the industry for being able to build mines, not only on time and on budget, but ahead of schedule and under budget, which they have done under their consulting company. And so it appears that they have parlayed that expertise into G Mining Ventures. And again, if you're one of those companies, and there's very few of them, and I would put G Mining, where appear to be Capricorn Metals, an Australian listed company, right, that was the ex-Regis team and the ex-Equigold team, have done the same thing. And if you go and look at some of the relative performance, where they've taken in the case of Capricorn, assets that are absolutely not tier one assets. They're essentially low grade, but very, very simple mining and metallurgy. And they take the same plug and play approach and they build very, very successfully on a very tight shoestring, and they reap that benefit in their share price. And so if you start to look at the share price performance of some of these builder developers that have grown their business through building on time and on budget, they have an absolutely exceptional share price performance. So definitely one to watch.
Well, I guess you touched on it, that G Mining has got a contract business building mines for other people. And if you want any proof whether they can build mines successfully or not, just look at Lundin Gold and the Fruta del Norte mine. They were the main contractor there. Now, also looking at expanding mines is Alamos Gold. They reported an internal economic study at its Puerto del Aire, or PDA, project within the Mulatos district in Sonora in Mexico. PDA is a higher grade underground deposit adjacent to the Mulatos open pit. Development is expected to start in 2025 with first production from mid-2027, and it's expected to nearly triple the mine life of the Mulatos district from 2027 out to 2035, with an average production of 104,000 ounces of gold per year at an all-in sustaining cost of just over $1,000 per ounce. Nicole, Alamos has been one of the best performing gold companies in recent years, and this Mulatos extension looks like being another solid move for the company.
Yes, Mulatos has been the gift that keeps on giving. I remember visiting that project back in 2003 or 4, and I believe Alamos acquired it for $200,000 or $300,000 from Placidome, which got acquired by Barrick. And so absolutely excellent job of, and it just shows the nature of our business, that often the resource that you think that you have, and this is the wonderful thing about geology, is start off with the 10-year life of mine, and here we are 20 years later and they're still growing, extending that business. I think they've done an excellent job. And again, this is a company that's also managed to do, and I think this is somewhat unique or rare in our sector, has done M&A that has been very, very accretive. And you've again seen that reflected in the share price.
Now, this is a brownfield project, and the company said it would yield an after-tax internal rate of return of 46% using base K gold price assumption of $1,950 per ounce, or 73% at current gold prices. Initial capital spend there of $165 million. With a lot of the bigger producers like Alamos having these brownfield projects that can yield high returns, that must be a huge factor in or a huge reason why there hasn't been more M&A that perhaps some people were expecting, particularly taking advantage of the disconnect between the gold prices and company share prices. Do you expect to see more of these kind of brownfield expansions rather than more M&A going forward?
I think any easy, low-hanging fruit brownfield expansions, they have occurred. Our company's obviously always focused on that, stepping out around your existing resource base and your existing mine, because that's the lowest cost ounce or production ounce that you can add to your books. So I don't think that takes away from the absolute need, and the pressure will become greater from investors as this strong gold price maintains itself and continues, is that investors will start demanding growth. And you cannot explore your way quickly into growth. It's just impossible. The timelines are too great, in excess of 10 to 15 years. So I think what that means is the developers, in my opinion, the developers will always become very, very attractive at a certain point in the commodity cycle. And they haven't become attractive yet, but they will be. And so I think you actually have, despite this incredible gold price run, investors have opportunities to get exposure to those development companies. And we are seeing M&A. We've seen with Goldfields and Cisco. Obviously, they already own half that asset, but that's a development asset and paying a hefty price for it. So you are seeing green shoots of M&A, and always as a cycle evolves and it continues as upswing, it's normally the companies that act earlier tend to do the most accretive deals. Because what happens is at one point in the cycle is all boards and management teams sit around and go, XYZ did that and they did that, we want one of those. And so everybody's running around trying to grab a smaller and smaller and smaller pool of assets.
Well, Calibre is a very good example of that. They were one of the first to do an M&A deal in this cycle, picking up the Valentine project that I'm here visiting now. Cool. Well, let's end with a what if I may. Next week, Kinross Gold said it will release a preliminary economic assessment for Great Bear in the Red Lake District of Ontario. That's perhaps one of the most anticipated studies in recent times, following its pre-resource $1.4 billion acquisition of Great Bear Resources in 2022. Nicole, what are you hoping to see in that PEA?
Well, it will be positive. All PEAs are positive. As someone I know once said, every single failed mine was built on a positive PEA. And one of the reasons it's always very positive is you can include inferred ounces in your economics. And so it is a loosey-goosey approach. So everybody has to be aware of that. It doesn't have the rigor, the economic and technical rigor of a pre-feasibility study and feasibility study. The company will be wanting to show that this was an asset, this was an acquisition that made sense. Personally, I think that they paid a lot for it. And what you don't see in economic assessments and PEAs is you never see them including the acquisition price. They essentially reset the cost from the point of looking at the asset. And so you do have to remember that they're all in cost of this. It's not only CapEx, it's the $1.4 billion that they paid to acquire this asset. I think in the long run, this is an asset that will be very, very long-lived. It's the deposit style, it's in the right terrain, but on the face of it, with the resource estimate that they came out with last year, if I recall correctly, they paid a lot on a dollar per ounce basis. But I think over the long term, this is an asset that will engender a material amount of value for the company. But we're in a business where you don't necessarily get rewarded for long-term thinking.
Now, here's a question. Next week is the Precious Metals Summit, and Kinross Gold is going to put this news out right slap bang in the middle of it. Why? Every single company does this, and my advice is to you all, just stop. No one looks at press releases. All the investors are so busy with back-to-back meetings. All the analysts are busy with back-to-back meetings, and every single company seems to save their positive news for the Precious Metals Summit and then wonder why there isn't a reaction in the share price. So my advice to all of you is to actually put out your news before these conference season, because we have the PMS conference next week, followed by the Denver Gold Forum the week after. And so it's a very, very, very busy 2-week period for everybody. So next year, put your news out early. I think it's daft to put it out during probably the 2 most busy weeks of the year for everybody. Insanity. But anyway. Absolutely agree with you. And you and I, we're both going to be there. Kitco will be at the Precious Metal Summit and the Gold Forum. You and I will be getting together at the Gold Forum and doing a Digging Deep live on the spot there. Thank you very much for joining me this week, Nicole. That's all we've got. See you in Colorado.
See you in Colorado. Safe travels.
You too. I'm Paul Harris, and this is Kitco Mining.